In this video, we're going to introduce you to the statement of cash flows. The statement of cash flows is a derived financial statement. And I say derived in that it contains no new information that's not already in the income statement or the balance sheet. So everything we do in this video is going to be taking information from those two statements, the income statement and the balance sheet, and reflecting the changes in the balance sheet through the statement of cash flows. And that's really what a statement of cash flows is it's looking at the changes in the balance sheet accounts all relative to cash. So we're going to see how each different account changes and how that affects what our cash balance is in the balance sheet. And we're going to reflect that through the statement of cash flows. So you can see here, I'm starting out with the statement of cash flows off to the right of my balance sheet and income statement. This is simply for visual purposes so you can see all of the statements at the same time. Normally, we're going to see the statement of cash flows sitting down below the income statement and balance sheet. All right, in this case, if I move it around a little bit, this would be more of a normal presentation and how I encourage you to build your models. Right? Having them layered on top of each other is very convenient for keeping everything in the same column, being able to drag those columns across, and we'll see that in future videos when we talk about modeling out longer-term financial statements. For this video, though, we're going to undo those couple changes, and we're just going to build it off to the right here so we can see everything and keep track of it at the same time. So the first thing we're going to do here is incorporate our net income. All right, this is often the very top line on a statement of cash flows. Here, we're just going to link to our net income. Again, the statement of cash flows is not going to directly refer to any of our parameters that we have over here. Rather, it's going to always reference the income statement and the balance sheet. So here we have our net income. Our cash flow from operations in this case is just the net income. We don't have anything else to add in yet. And then the other part of the statement of cash flows is just let's look at the beginning cash relative to the ending cash. So our beginning cash, we can pull that from the balance sheet in the prior period. Our change in cash, that's simply going to be equal to the subtotal of the cash flows from operations and each of the other sources, financing and investments that we'll see in future tabs. That gives us our change in cash, and then our ending cash is simply the beginning cash plus the change. And here we see we have an ending cash of $2,000. Now I said earlier that the statement of cash flows reflects all the changes in the balance sheet relative to cash. And here you notice I actually pulled my net income from the income statement. However, I can get this same number from the balance sheet. Rather than using net income, I can use change in retained earnings. So if I come down here and I do change in retained earnings, which is retained earnings this period, minus retained earnings in the prior period, that is also $2,000. In this case, it works because we have no dividends, but in the future, when we do have dividends, what you'll see is that the net income is reflected in the cash flow for operations, the dividends are reflected in cash flows from investing, from financing, and when we add those together, we get the change in the retained earnings. So every change in the balance sheet is reflected on the statement of cash flows.